Have you ever stopped to wonder why the housing market seems to be on a never-ending roller coaster ride? It's a curious question, isn't it? As we speak, we're witnessing a peculiar state of the housing market. Property prices are soaring to the sky, seemingly on a mission to breach the stratosphere. This surge is driven by an insatiable demand. It's as though everyone woke up one day and decided they needed a new home. But what's fueling this voracious appetite? Well, it's a potent cocktail of historically low interest rates and rising inflation. These low rates have made borrowing cheaper, encouraging more people to take the leap into home ownership. Meanwhile, inflation is eroding the value of money, making tangible assets like property a more attractive investment. Yet with every high comes a low. With such a volatile mix of factors at play, it's a precarious balancing act. With the current state of affairs, one can't help but ask, are we on the brink of a housing market crash? To understand where we might be headed, it's crucial to trace our steps backward. Let's take a walk down the timeline of events that are leading us to a predicted crash in the housing market. Our story starts in 2020, in the grip of a global pandemic. The world was at a standstill, and the American economy was no exception. As a response, the Federal Reserve slashed interest rates to historic lows. This move was a lifeline for many, making borrowing cheaper and stimulating economic activity in a time of crisis. But every action has an equal and opposite reaction. These low interest rates ignited a boom in the housing market. Home prices soared as buyers, fueled by cheap credit, entered the market in droves. It seemed like a golden era for homeowners, a time of prosperity and growth. But as we know, all that glitters is not gold. Fast forward to today, and we're seeing a sharp rise in interest rates. This increase is making mortgages more expensive and for many unaffordable. The once thriving housing market is now teetering on the brink of instability, but that's not all. We're also grappling with inflation, the silent thief that erodes the value of money. With prices rising across the board, the cost of living is surging, putting additional strain on homeowners. So we have a potent cocktail of high interest rates and inflation, a combination that could potentially trigger a crash in the housing market. It's a precarious situation, like a house of cards that could collapse at any moment. And if history has taught us anything, it's that booms are often followed by busts. Just think back to the housing market crash of 2008. A similar pattern is emerging, and we must be prepared for what lies ahead. The patterns of the past often illuminate the possibilities of the future. With the current trends, a crash seems more like an impending reality than a mere possibility. Having traversed the path that led us here, let's summarize what we've uncovered. We began our journey by painting a picture of the current state of the housing market. We saw a landscape punctuated by soaring prices, record low inventory, and an unprecedented demand for homes. These factors have created a bubble, a frothing bubble that's teetering on the brink of bursting. Then we tread the path that may lead to the predicted crash. We examined the role of mounting interest rates and the spectre of inflation. Both are like the proverbial wolves at the door, each contributing to the potential destabilization of the housing market. Interest rates, they act like a pressure valve, keeping the market in check. But as they rise, they increase the cost of mortgages, making homes less affordable and potentially bursting the bubble. And inflation, that creeping, insidious force, erodes purchasing power, making every dollar less effective in the housing market. We also peered into the abyss, looking at the potential fallout from such a crash. A housing market crash isn't just about dropping home prices. It's a ripple effect that can impact the broader economy, affecting jobs, consumer spending, and overall economic health. But all is not doom and gloom. We also discussed strategies for navigating this potential crisis. These include being financially prepared, understanding your risk tolerance, and staying informed about market trends. Diversifying your investment portfolio and having a solid financial cushion can help to weather the storm. As we conclude, it's worth emphasizing the importance of being financially prepared. This is not a drill, nor is it a fleeting concern. It's a very real scenario that could have far-reaching implications for homeowners, potential buyers, and investors alike. As we stand on the precipice of a potential housing market crash, It's clear that understanding these dynamics is not just important for economists, but for anyone with a stake in the housing market. Remember, knowledge is power, and in uncertain times it's the best tool we have to navigate the stormy seas ahead.